Hey there, welcome back. Now, when we started this course, we said that when it comes to the stock market and stock exchanges, you can buy stocks either in the primary market or in the secondary market. We also said that we'll cover this topic in greater detail in a later lecture. So, in this lecture and the next lecture, we are going to look at primary market and secondary market. In this lecture, the focus will be on primary market, and in the next lecture, we'll cover secondary market. Now, in the initial stages of any business, the capital for the business is brought in by promoters and their relatives or friends. Now, this is how most businesses start, but as the requirement of capital grows, it becomes necessary to source funds from a wider group of investors. This may be because the existing investors either do not have the capacity to invest more, or maybe because they want to reduce their dependence for money on a small group of people. Primary market is essentially the market where debt or equity securities are issued by businesses. Hence, these businesses are called the issuer. Now, the issuer receives funds from investors. These investors may be individuals or institutions. Since investors are buying securities directly from the issuer, this market is known as the primary market. Also, since the securities are issued for the first time in this market, it is also known as the new issue market. This process of issuing securities in the primary market is commonly known as going public. Through this process, the retail investors or the public gets the opportunity to buy these securities for the first time. Apart from the promoters of the business, sometimes even institutional investors like private equity funds offload their stake in a business by selling some or all of their securities in the primary market. Now, the ability of a company to raise funds through primary market depends on the performance of the company in the past and also the company's expected performance in the future. Now, when investors are buying securities in a new business, they require protection against a possible default or against their rights getting diluted in some way. Since primary market securities are issued under scrutiny of the regulator, these securities are protected against such wrongdoings. Regulators impose obligation on issuers in order to ensure that issuers honor commitments made at the time of raising funds. Apart from this, the new investors in the company also need the flexibility to exit the investment when needed. Since these securities which are issued in the primary market are listed on the exchanges, the investors now have the opportunity to exit the investment as and when they see fit. This also means that even if the shares of a company change hand and go from one investor to another, the existing business essentially remains unaffected. Also, since exchanges require companies to regularly disclose key information, the investors can regularly evaluate their investment and the stock prices reflect the expected performance of the business in the future. Another question that commonly is asked by many new investors is that are all issues in the primary market open to the public or the retail investors? Now, the short answer is that not all primary market issues are open to the public. It is very common for companies in early stages of growth to issue equity capital to certain institutional investors only, like venture funds and private equity investors. Only when the issuer doesn't choose any specific group of investors but instead offers securities to anyone interested in buying a security, only then the issue is called a public issue. Now, we have presented here a rough classification of various types of issues in primary market. Let's briefly look at them one by one. The first of them is the public issue. A public issue is issued to members of public or anyone interested in buying security, including various institutional investors. The public issue may be an IPO, which is the initial public offering, or an FPO, which is the follow-on public offering. We'll cover these terms in a bit. The next type of issue is called private placement. Now, when securities are issued only to a select set of investors like institutional investors, this is known as private placement. Then you may have what is known as the qualified institutional placement. This is essentially a type of a private placement only, which is done by a listed company to qualified institutional buyers like mutual funds. Another type of issue is the preferential issue. Now, in case of preferential issue, the securities are issued to an identified set of investors on preferential terms. These preferential terms may be offered to promoters and employees also. Through these preferential issues, the promoters and employees may get superior rights when compared to a normal investor. Another type of issue is what is known as the rights and bonus issue. Now, rights issue is where the securities are issued to existing investors in order to enable them to buy more securities at a specified price. Now, in case of bonus issue, the existing investors get allotment of additional shares without any consideration, that is, without making any extra payment. Now, coming back to the most common of these type of issues, which is the public issue, we said that the public issue may be an IPO or an FPO. So let's look at what is an IPO or what is an FPO. Starting with the IPO. Now, IPO is the first public offer made by a company. Post the IPO, the shares of the company become widely available for investment by retail investors and institutions. Thus, there is a change in shareholding pattern of the company, as instead of just the promoters and some select institutional investors, various different types of investors also become the shareholders. Now, IPO may involve either fresh issue of shares by the company, or it may involve offer for sale by existing promoters or institutional investors. The fresh issue of shares involves company issuing new shares so that they can be sold to the public. Since new shares are sold, the issued capital of the company increases and the percentage shareholding of existing shareholders comes down. On the other hand, in case of offer for sale, the existing shareholders of a company offer a part of their holding to other investors. Now, in this case, the issued share capital of the company does not change, as the company doesn't issue new shares. Also, the proceeds of these sales go to the existing shareholder who are offering their stake for sale, and hence the proceeds do not go to the company and there is no change in the capital structure of the company. As a result of sale of shares, the percentage shareholding of existing shareholders comes down, while new shareholders see their percentage shareholding go up. Now, the next type of public issue is the FPO or the follow-on public offer. The FPO is made by an issuer that has already made an IPO in the past but now wishes to make a further issue of securities to the public. So, for example, if a business has gone through an IPO process and so is now listed on a stock exchange but now wants to raise more capital to the public, they can do so by the way of a follow-on public offer. Now, usually a company takes the FPO route when it requires additional capital for growth, or if it requires to restructure its capital by retiring some debt. Now, sometimes FPO may also happen through offer for sale, where existing shareholders may offer some of their shares for sale. This may happen if the promoters would like to dilute their holdings in the company after the lock-in imposed at the time of the IPO is over. Now, with this, we have broadly covered the important terminologies surrounding the primary market. In the next video, we are going to look at the secondary market.